Welcome to the stock play of the day. Today's stock is the QQQ. That is the ETF that tracks the NASDAQ. We'll discuss, should we pass or should we play? Hello, everyone. My name is Brian Overby. I am the Senior Options Analyst with Ally Invest.
And I'm Callie Cox, Senior Investment Strategist here at Ally Invest, filling in for Lindsay Bell.
Well, Callie, I have a chart of the S&P 500 index up here. Very interesting week in the market last week. What do you see going forward this week?
Well, Brian, today we're seeing a little bit of a reversal of fortune, actually. Stocks are up about 1% today. You can see that on the S&P 500 chart. But last week it was a little rough. So stocks being up is an encouraging sign. So let's talk about last week for a second. You know, the S&P 500 did fall about 3% after some pretty rough days on Wednesday and Friday. There weren't many big headlines during the week that pushed stocks lower, but it was more of a slow burn as investors watched infection rates grow and a bunch of new coronavirus hotspots around the country. And it all kind of goes back to this market narrative that we talked about a lot of investors reconciling just where we are in the economic recovery and the whole coronavirus situation with these stock levels we've seen. I mean, after all, the S&P 500 is about 10% from a record high, and the NASDAQ, like we'll be talking about later on in this show, the NASDAQ is about 4%-ish away from a record high as well. So investors are looking at that and saying, maybe let's take a step back here. Things don't look so great. The economy still is looking pretty fragile. So does it make sense for stocks to be at these levels? Sure. Yeah. Taking a step back. Moving average, stocks moved a little bit higher and then rocketed higher after breaking that important support level. So that's important to consider. Overall, there is a lot to consider this week in what will be a thinly traded week during a holiday week for the market. The stock market is closed, by the way, on Friday, July 3rd. It'll be closed for July 4th, but we'll be getting a load of economic data this week. We'll be seeing June consumer confidence, June ISM manufacturing data, jobless claims, because we see that every week, and the June jobs report. So don't sleep on the market this week. You know, there might be lower volume, but there still are a bunch of very important data points coming out. So I did mention the 200-day moving average. That's been an important level of support for the market. You can see it on the chart right here. The S&P 500 did fall below the 200-day moving average on Friday and then plunged below it intraday after it broke that key level. So breaking below the 200-day isn't quite a good sign for market stability. You know, today we are higher. We did break the 200-day in the S&P 500, but the market has done this a few times already, yet has struggled to maintain momentum. So that is important to note. It is a good sign, but lately it hasn't been the kind of floor that we would usually expect. So let's talk a little bit more about this week. There's an important technical level in play, as we said before, and we're seeing growing levels of nervousness in other markets. The 10-year Treasury yield is still near a record low. It's around 65 basis points at this moment. And gold, the quote-unquote safe haven precious metal trade, is climbing towards a 7-year high. So gold still is very high, even though stocks have rebounded quite a bit off the March lows. So that's a lot. And overall, we could see some early fireworks this week. Brian, what are you seeing out there?
All right. So like on the VIX, one of the big things that kind of goes along with what you're mentioning in gold is the fear of the market is still there. We saw the increase in coronavirus numbers over the weekend, pretty bad numbers overall. And when the market was climbing, once we announced that we're going to be reopening, we saw the VIX actually come running back down to around the 20% level, actually hung around 25% for quite a while. But now we're having a real tough time breaking that 30% level in the VIX. The volatility index that tracks index, the S&P 500 index. Right now we see it trading right around 32. It's only down about a point today on an up market. It's just showing that there's still a lot of fear in the marketplace. And I actually drew a couple of trend lines that we've been talking about a lot here on the stock play of the day. First of all, I see the blue trend line is kind of how I had it drawn earlier. We definitely broke through that in the S&P 500 index. And so I've kind of redrawn that trend line. I'm going to just remove it right now, moved it up a little bit. And we see here we have 3 different touch points on this trend line, and we kind of broke through that too. And now we're down below the 200-day moving average. So the story in the S&P 500 index isn't a strong one overall relative to the NASDAQ or the QQQs, which we're going to be chatting about just a little bit. But if we see here, the moving averages have provided some support and some resistance on the way up and on the way down. So in this instance, we see we broke below the 200-day moving average. I think the 50-day is in play as if we close below that. Even though we do have a slow week, as you mentioned, Callie, we should probably see lower volumes overall this week, just in general. But looking at the SPX, it's a much different story if we just flip over to the Qs, which I'm going to do right now. So in the Qs, I have a couple of things that I want to highlight before I toss it back to you. One of the biggest things is that this was the old high in the QQQs / NASDAQ. And the oldest adage that is in charting is that when you see an underlying breakthrough resistance to the upside, it becomes support to the downside. So you mentioned that we were down big on the open. Well, not necessarily big, but we were down on the open. And you see that the market, the QQQs, actually came down and touched that old high, and it did provide some support. So now we're getting a little bit of a move to the upside. I also have a channel. This is a very strong channel, a much more bullish channel than in the S&P 500 index. And we've broken through it a couple of times, but it's been able to kind of hold up. And now we're trading on the lower end of that channel. We saw some support that was provided by that old high. We're still above the 200-day, which is the blue line here. It's kind of hard to see. Above the 50-day, and well, here's the 200-day, the 50-day, and the 20-day moving average, just kind of hanging out in those levels. But overall, the NASDAQ is a much different story than the SPX. What do you see going forward in the QQQs, Callie?
Well, that's a great question, Brian. And tech has actually been a very interesting space lately. We actually wrote our weekly note, Lindsay and I did, on the tech space that came out Friday. So definitely check that out. But, overall, tech has had a spectacular run. And tech, when I say tech, I mean tech, QQQs, NASDAQ, securities like that, indexes and securities like that. But tech has had a spectacular run since the March lows, and it's held up really well in recent volatility. We think we're actually seeing technology become one of the new defensive plays for the market. It's kind of a combination of investors gravitating towards what they know and what's worked well for them before, tech, and looking fundamentally towards what could be a compelling investment for the future, which could also be tech. If you think about the quarantine trade, quarantine has pushed the world to think of more technological solutions. And the market thinks tech company revenues could be one of the big beneficiaries of that. Makes a lot of sense. Although it is hard to tell how much they'll benefit, and for every pro, there is a con. So it's still too soon to tell if the 40% rally in tech stocks is still warranted. But we are feeling pretty encouraged by the strength we're seeing in tech so far. Not necessarily today, tech is underperforming, but over the past few months, tech has definitely been one of the brighter spots in a market that hasn't had many bright spots lately. So I think the QQQ could be an interesting trade today. I want to get your thoughts, Brian, but before I do, let me remind viewers to drop your questions in the chat. Brian and I will be answering your questions live at the end of the show. So please pick our brains if you have any questions. And with that, tell us about the trade, Brian.
All right. Thanks, Callie. Okay. So we're looking at the Ally Invest option chains. We see right now that we are up about 0.5%, not extremely strong, but we are up, which is a good sign overall in the QQQ. That means that we did get a little bit of a support from that old resistance mark in the QQQ, which was the old high. And we're getting a little bit of a bounce back on it. So what we're going to look at doing is a momentum play. When we're talking about the Qs, overall, that means that we're just a little bit more bullish on tech stocks because that's really what the NASDAQ is made up of. And we're going to look at a bull call spread, a fairly short-term one. So we're looking for a pop to the upside. A bull call spread means that we're going to be buying an option contract that's going to be a little bit in the money, and then we're going to be selling an option contract that's a little bit out of the money. We're going to be paying a lot of attention to how much time premium we're buying versus how much time premium we're selling. So right now I'm showing you the long call spread inside the Ally Invest options playbook. You want a little bit more of a summary on it, you can always go to theplaybook.com and check out the options playbook to talk a little bit more about the break-evens, the fundamentals of a long call spread. So let's get back to the Ally Invest option chains. And you see here we have the July 17th expiration. Now, this is the normal monthly expiration. You'll notice it doesn't have a W next to the expiration date. That I prefer to stay in the monthlies if we can, but the Qs is a very liquid index overall. There's not the bid-ask spreads are fairly narrow usually in the Qs. So it makes it easy to get in and out of your trade overall. We're going to go a little bit in the money like I was talking about when we're looking at the options playbook. The Qs are at 241.59. This is a live quote. On the left-hand side, we have the calls. We're buying the 240 strike call. That's 735 by 740. So it's a fairly expensive option contract. Now, a little quick and dirty trick is if you want to know the approximate time value that's in the call, we go over and we look at the put. And the put is 570 by 573. So when I'm selling an option contract, I want to make sure I don't have too much exposure to the time decay. And here's the big reason why is that we've been talking about volatility. The markets are extremely volatile overall. And what that normally means is that the options will become pricey, quote unquote, compared to less volatile times. And that's why we're leaning towards a long call spread here, as opposed to just buying an option outright. So we're paying a bunch of time premium, even though it's only an 18-day trade, we're just a little bit in the money. So we're going to sell approximately that amount of time premium. And by approximately, we're going to be off by about $1. Now, you can try to be more sell as much time as you are buying, but that doesn't give you as much upside. So I'm going to sell the 245 strike call option here. And now, once again, this is a paper trade. It's not meant to be a recommendation overall. And that is trading for 450 by 454. Like I said, fairly tight markets, a few pennies wide, but I'm buying I'm buying more time premium than I'm selling, but it's not an outrageous amount. So this means that we're going to have a decent risk reward on our trade, and we're not going to have as much susceptibility to fluctuations in implied volatility and into time decay because we're doing such a short-term trade overall. Once again, momentum trade. And overall, we're just looking at this to try to see how the prices work out. And when you have conditions where you have higher implied volatility, we like to look at strategies and learn from these strategies based off of what I might do if implied volatilities are high and you're trying to do a momentum trade. Okay, so to figure out the risk reward of a long call spread, we have a 5-point wide spread. The difference between the strikes from 245 to 240 is 5 points. We're going to, if we can fill at the midpoint would be $2.80. Now, it's never a guarantee that you can fill at that price, but this is what we're going to work off of. That means our total risk would be that $2.80, and our total upside would be $5, the width of the spread, minus 280, or $2.20 overall. So I'm going to make this the official paper trade. If I put it over here in the right rail, and I'm going to click on this, I'm going to go 280. I think 280 is a fair price, no guarantee of a fill there, but very rarely if you're trading spreads do you ever do it at market, mainly because you're dealing with two different option contracts. You always want to work spread trades if you can. So here's the trade. We're buying to open the July 17th expiration 240 strike call option. We're selling to open the July 17th expiration 245 strike call option. We're hoping to fill somewhere around the midpoint of $2.80. That's going to be our max risk on the trade. Don't forget to add commissions in when you're doing that. And our max upside would be $5, the width of the spread, minus that 280 or $2.20 overall. Now, just to show you the profit and loss graph here, let me pull this up. This is the Ally Invest profit and loss graph. And you notice it looks really close to what the long call spread does inside the options playbook. So I go back, this is the dotted line, that's at expiration. That's what the playbook highlights. This is as of today. Now the colored line that goes through the middle shows you as of today what the profit and loss graph would look like, considering high implied volatilities, the days to expiration, and everything that's involved. So part of the reason why I'm showing you this inside the Ally Invest option chains is that picking your expiration is extremely important on long call spreads, because you have one option contract that you've sold that wants the market to stay where it's at or go down. And then you have one option contract that you bought that definitely wants the market to go up. So they fight each other. And that means overall that on a long call spread, we'd like to be correct on our forecast closer to the expiration date. And to do the other side, if we're going to be incorrect, we want it to move against us right away, because these option contracts and the time premium helps us out. So we see we're kind of a flat line right now. I'm going to actually change the days to expiration. We've got 17 days, which is a long amount of time in an underlying like the QQQ. That's a lot of time. That actually feels like a year in this type of marketplace. But I'm going to knock this all the way down to 3 days and watch how much that line will change. And now it becomes much more slanted. And then we'll go all the way down to 0 days, which is really 1 day remaining to expiration. And you see, in this instance, now it looks very similar to the dotted line, which is at expiration. So, moral to the story, if you're doing long call spreads, it's great that you're correct on your forecast, but overall, the most ideal scenario is that you would be correct on your forecast closer to the expiration date of the option contracts. All right. Well, that's going to be it for the trade this week, the paper trade this week. Callie, do we have any questions out there?
All right, let me check, Brian. All right, so we have one question, and I think this is a good one for you, Brian. It's from William Johnson. Hi, William. And William asks, would it be safer to trade a ratio spread with calls for QQQ given volatility in markets lately? So,
all right, so William, I feel like that's a loaded question. You must have been watching some of my podcasts, because I've talked a little bit about ratio spreads. I like the ratio spread overall a little bit better as opposed to a short call spread or a short put spread. And I've talked about that on a lot of my podcasts inside Options Playbook Radio, about looking at not only looking at ratio spreads, but also looking at I guess a brother to the ratio spread, which would be a skip strike butterfly. Now, I know that's a fancy term. It's inside the Options Playbook. You can always check it out, a skip strike butterfly. And we looked at a lot of those as alternatives because we want to define our risk by doing that type of trade. So great question. If I'm going to do a momentum trade, though, I'm going to stick with the long call spread, and we're just hoping that we did get a little bit of support from that old high in the QQQs, and that it continues into this holiday week of trading overall. All right, Callie, any more we got?
Let me see. All right, we do have one question from Hugh Montgomery. Hi, Hugh. He says, where is that options info? I'm not finding it. So would you mind just refreshing us on how we can get to the options chain screen in the live platform?
Sure, without a doubt. It's quite simple. Once you're logged into your account, I do think that our live trading platform is one of the easiest platforms in the marketplace to actually enter a long call spread overall. And the checkboxes make it that way. But all we have to do is actually look under the research tab and scroll down to options. Type in the QQQ and away you go. The chains will pop up overall. All right, back to you, Callie.
All right. I learned something new there. Okay, we have another question from Stein3D. Hi Stein. Stein asks, for clarity, would you be able to discuss a hypothetical market move up or down in the trade you just outlined and review how one might exit the trade? Emphasis on hypothetical, Brian.
Yeah, total. And once again, these are always meant to be paper trades, so they're not meant to be recommendation. We need to learn before we dive into option trading, and that's the whole goal of the stock play of the day overall. I did a little bit of hypothetical here, and it looks like Sten 3D is, I think, the name, if I recall. But one of the things that I'm looking at, let's go all the way back to day 17. Here's where you can see the hypothetical. If you do this trade and you have the underlying market skyrocket on us, we really don't max out until we get quite a bit in the money on day one. But it's also the case on day one that if the market goes down, that also doesn't hurt me as bad. And it's all about that increased implied volatility that we have in the marketplace with long spreads. If we're going to be correct, we need some time decay to work for us. If we're going to be incorrect, we don't want time decay, because time is our friend. It's going to help us on that long in the money option contract that we have. We want as much time premium to stick around. So how could I approach this trade? Well, one of the things that I noted here is that we're trying to buy approximately as much time as we were selling. So we kind of have our risk reward figured into the trade. Now it's a live market. Ideally, I wanted this to be you paid $250 for the long spread, and you have $250 worth of upside on a 5-point wide spread. But the market moved a little bit. I'm okay with where it's at. So when we were looking at the trade, it was $2.80. So you can say to yourself, and this is one way you can manage your risk overall, you can say, well, if I'm down $1, I'm going to pick $1. That seems to be a magic number. On the downside, I'm going to close. So if this starts trading for 180, I will sell and close my long option and buy and close my short option. Now, I'll say, well, on the upside, I'm going to let my winner run. If the market is going on up, I'm still hoping to make as close to that $2.20 or maybe $2 on that position. So I have $1 of risk in my portfolio on the downside, and I'm hoping to make $2 on the upside. That's not a bad risk reward ratio to try to pull off if you're approaching this trade. Now, we're going to come back on Thursday, and we'll talk about what happened in the marketplace, and we'll look at if there are any other adjustments that we might make to this underlying trade. But the biggest thing about a plan is you got to stick to that plan. And this is a great question. I really appreciate the question overall, because when you're looking at option trading, the best option traders have a plan and then continue to implement that plan going forward every time they do a long call spread. That's a momentum trade overall. This is going to be my plan, and I'm going to apply it to that new underlying that I'm looking at. All right, I see a few more. I guess we got time for a couple more here. Yeah, let's move forward, Callie. What else do we have as far as questions? I see them popping up in the chat box on the left and right here.
Yeah, it's a great day for questions. Wow, you guys are impressing me over here. All right, so we have a question from Amit 111978. Hi, Amit. So Amit asks, what is the best way to find the time value of an option? And then a follow-up question. Also, how do you screen potential bull spreads, maybe in the Ally Invest platform? So what are your thoughts, Brian?
Well, I'll start by just looking at time value. Now, ideally, time value is figured. I talked about the 240 strike call, which I'm showing my option chain right now. The time value would be the intrinsic value minus the premium on the option contract. So I'm not going to do it exactly here because the markets are running. It's pretty hard to do. But overall, we see, let's call this 241.80. All right, $1.80 in the money. So if I have the 240 strike call and I'm $1.80 in the money, that means I have $1.80 worth of intrinsic value. You take that intrinsic value and you subtract it from, let's say, the midpoint. Well, here this market's real tight. We'll say $7.45, somewhere close to the midpoint. And that will give you the total time value. Now, in the options world, though, there's a benefit that puts and calls usually trade fairly close to the same time value. And if the call is in the money, the put will be out of the money. that means that that put is going to trade for approximately, in theory, it's going to trade for the exact same time value. That's in the theoretical world. In the real world, there's a little bit of fudge factor there. So all I'm doing when I'm looking at setting up a long spread is trying to figure out the approximate time value. I want to know approximately how much time I'm paying and how much time I'm receiving. So by doing that, just quick and dirty, and that's what I reference it. Just look at the put. So this has about $5.67, 68 cents worth of time value in it. So how much exposure am I willing to take when it comes to time value? And I went out and sold the 245, because if I sell the 244, the 1 point strikes here, I don't have as much upside, but I have less exposure to time value. So that's how I just do it in a quick and dirty fashion, by looking at the trades overall, because it's not an exact science. I don't need to sell the exact amount of time premium that I'm buying. That might be my goal, but that's not necessarily my strategy. We're doing this more as a momentum trade because of the things that Callie has talked about, the NASDAQ overall, and just from looking at the chart. All right, another one. Let's keep going. We still got a few more minutes. Why not?
All right. Well, let me see if there's one for me. Oh, okay. I have one for me. All right.
Excellent.
This is from, yeah. This is from Heels Fan 82. Heels Fan 82 asks, why would I buy the QQQ instead of just buying Apple? Because Apple is doing really well right now. All right. So like I said, I'll take this. Well, Heels Fan, by the way, go Heels. Big Tar Heel fan over here. Well, if you think about it, QQQ holds a bunch of different tech stocks, not just Apple. So by buying QQQ or, doing an options trade on QQQ, you do get more exposure to the overall tech sector. I mean, by the way, Apple has had a great run since March. I mean, all tech stocks have, but Apple has been one of the shining stars. However, it is looking a little frothy here. Like I said earlier, it's tough to place a good valuation on tech stocks these days, even though there are several good cases out there for investing or owning tech stocks at the moment. So why would you buy the QQQ here? Well, I can't tell you definitively. We don't make recommendations, but the QQQ might be a good idea if you want to diversify your portfolio to include more tech stocks. That's important. If Apple does stumble here because of some company-specific news, it is important to have those other tech stocks in your portfolio as a buffer, again, in case something happens. So there you go.
All right. Well, I think that's going to be it for this episode of the Stock Play of the Day. All right. Now, it's a holiday week. At the end of the week, we're going to have the markets are going to be closed on Friday. So we're going to do the Stock Play of the Day overtime edition at noon Eastern time on Thursday. Make sure you hit subscribe and ring the bell so you get all the notifications for that. And then we'll also be taking the following Monday off from the Stock Play of the Day. So I want to thank you all for coming, and make sure that you click that subscribe button and ring the bell.
Yep. Have a good week, everybody, and happy 4th.